Are you intrigued by the potential for passive income, long-term wealth creation, and financial independence that real estate investing offers? Discover the paved way to financial freedom by learning how to successfully invest in real estate. Hello, this is Samuel Feron, and you are listening to Real Estate Investing: Strategies for Building a Profitable Portfolio of Investment Properties with Insights on Market Analysis, REITs, Rental Property Management, Flipping, Taxation, and more. Provided to you by United Audiobooks. I hope you enjoy my audiobook. Now, let us begin. Introduction. One of the finest ways to make money is through real estate investing, a wise choice all year. Even yet, it can be difficult if you lack basic understanding and direction, especially if you are not familiar with the area where you intend to make investments. It is better than mutual funds, fixed deposits, shares, and bonds, but it might destroy your life savings if you don't understand the basic regulations controlling this sort of investment. The real estate sector is developing and enticing. Real estate has developed into a multi-trillion-dollar sector and is still a crucial aspect of daily life. In summary, whether at home, at work, during leisure time, etc., we all understand the importance of having a roof over our heads, and these roofs are constructed with certain materials and fulfill specific roles. Understanding the framework of the real estate market industry requires knowledge of the following concepts: economics, risk, and investment. Real estate investing has a fairly straightforward philosophy. The aim is to put money into investments and let it develop so that more money is available. All investments involve risks, but the potential benefit must outweigh the risk. Consider the game of Monopoly as an example. To succeed, one must buy homes, avoid declaring bankruptcy, and collect rent to pay for even more homes. If only everything were that simple. Although the idea is similar in real life, making a mistake during the investment process could have disastrous results. When you're ready to begin investing in real estate, you should choose a certain kind of real estate. This book provides information about the types of real estate investments that best meet your needs and goals. Whether you are a beginner investor or experienced, you will learn about all the steps involved in the investment process. Chapter 1. Understanding Real Estate Investing Basics. 60% of all assets globally are classified as mainstream. Real estate makes up a considerable amount of all national, corporate, and individual wealth. Given this, it is obvious that anyone searching for asset classes to allocate some of their cash to should give real estate investing some thought. But understanding the basics of real estate investing is necessary before you can decide whether or not to invest in real estate and which of the numerous forms of real estate would make the most sense for you. This chapter aims to provide you with a thorough introduction to real estate investing. It addresses the question, what is real estate, that even some seasoned real estate investors find difficult to answer properly. What is real estate? Real estate investing is the purchase, ownership, acquisition, and administration of land, properties, or anything else for financial gain. Real estate can be a beneficial addition to a portfolio of investments. Every piece of real estate is different, and they aren't creating any more of it. Whatever sort of real estate investing you choose, real estate is a terrific way to increase your return on investment. Whether you want to be a very hands-on investor or fully hands-off, a wide variety of options are available to real estate investors. Why real estate is a popular investment choice. Real estate is a very solid investment since a tangible asset backs it. An investment property will often hold its value and increase over time. It is improbable that you would suffer a total loss on a real estate investment if you pay your mortgage in full each month and have the appropriate insurance. Real estate can be a secure option to spend your hard-earned money on something constantly in demand because people will always need a place to live. Therefore, it shouldn't be surprising that real estate is a common investment nowadays. Let's examine some of the additional factors contributing to its popularity. Investors make a profit very quickly. Real estate investors can start seeing cash flow immediately, depending on the investment and how it was obtained, i.e., with or without financing. For instance, a turnkey real estate investment already has a desirable tenant and has been thoroughly refurbished. You get your first rent check at the end of the first month. Equity and long-term appreciation grow over time. Long-term real estate investments generate a monthly positive cash flow and increase equity. You use your tenant's rent to pay down every mortgage payment. You are ultimately having someone else pay for your investment when you pay off a mortgage with the money provided by your tenant. The second advantage of a long-term real estate investing approach is appreciation. In the majority of markets, property values increase with time. Zillow reports that real estate value in the U.S. has climbed by 6.9% yearly. Therefore, the home you buy now for $150,000 could be worth $292,000 in 10 years. Low barrier to entry. Getting started as a real estate investor is not as hard as it sounds. To make your first investment, you don't need to have thousands of dollars on hand. Utilizing the several available financing options is the key to success for several real estate investors. You might only need to pay 20% down on the house to begin investing in real estate, and you can finance the other 80% with a low-interest mortgage. Other possibilities, such as non-recourse loans, hard money, or even personal loans, are available if you cannot obtain a mortgage. To maximize your real estate investments, you must know your financing alternatives. Investors have the option of using leverage. An investor usually needs $100,000 in cash to purchase $100,000 worth of stocks or mutual funds. However, a real estate investor can purchase a piece of property worth $100,000 for only $20,000 in cash and the rest $80,000 via a loan. Even though some properties, think fix and flip investors, might not qualify for a regular mortgage, many real estate investors can obtain several mortgages and expand their portfolios with as little as 20% down on each home. As we will explore in more detail later in this book, real estate investors use conventional financing to leverage their cash on hand so they may buy additional properties and optimize their investment chances. Real estate has a low barrier to entry and high growth and diversification potential for a portfolio. Investors can purchase properties practically everywhere using resources like reputable property management firms. Investors benefit from tax breaks. Tax breaks available to real estate investors are not available to other investors. A real estate investor may claim the following deductions: mortgage interest, depreciation, property taxes, insurance, repairs and upkeep, and travel expenses for business purposes. Other strategies exist to prevent a real estate investment from going under, such as using a 1031 exchange to reduce capital gains taxes. Deductions may result in a higher positive cash flow for the investor and a lower tax bill. The time commitment can be adjusted. Turnkey investors merely use real estate investments as extra passive income, whereas fix and flip investors and investors who serve as property managers make investing their full-time profession. Different time commitments are needed depending on your investing approach. Investors can manage risk. You've probably heard the saying, the higher the risk, the greater the reward. This proverb has stood the test of time and applies to real estate investing. Lower class assets can offer higher yields on paper, but they also carry a greater risk of loss. Although higher class assets typically have lower yields, they are considered safer investments. Investors can choose real estate investments based on their risk tolerance, much like in the stock market. Types of real estate investments. Real estate investments come in various forms, but the majority can be divided into two groups. Real estate investments that don't involve the ownership of physical property, such as REITs and crowdfunding platforms, include tangible assets like land, homes, and commercial buildings. Traditional, tangible real estate might yield a high return on investment, but it can also come with substantial upfront and recurring costs. Due to the reduced financial entry requirements of REITs and crowdfunding platforms, investing in a variety of real estate is far more affordable than buying even one traditional property. Another benefit of alternative real estate investments is the unique advantage of not having to leave your home or put on clothes to begin investing. Here are 5 different sorts of real estate investments to take into account. 1. REITs. Real estate investment trusts, or REITs, own commercial real estate. Think of hotels, offices, and shopping centers. Shares of these businesses are available for purchase on a stock exchange. You can participate in these companies' real estate by purchasing a REIT without taking on many of the risks that come with direct real estate ownership. 2. Crowdfunding platforms. Crowdfunding platforms for real estate give investors access to real estate ventures that could yield huge profits but also come with many risks. Some crowdfunding platforms are only accessible to accredited investors, who are those who have a net worth of at least $1 million or a joint net worth with a spouse, excluding the value of their home, or an annual income of at least $200,000 over the previous 2 years, $300,000 with a spouse. 3. Residential property. Residential property includes single-family homes, condos, and vacation properties, almost any place people live or stay. Investors in residential real estate generate money by charging rent to tenants, or monthly payments for short-term rentals. 4. Commercial property. Commercial property is a location that a company rents or leases. Commercial real estate includes leased restaurants, gas stations, strip malls with multiple businesses, and office buildings rented by a single company. Each firm would pay the property owner rent unless it owned it outright. 5. Vacant land. Will they come if you build it? Investors often purchase the land for either commercial or residential construction. However, if you intend to develop the land yourself, buying it for development involves some market research. The person most suitable for this form of investment has a sizable amount of money to invest, in-depth knowledge of all things real estate, including building codes, zoning laws, floodplains, and knowledge of the regional residential and commercial rental markets. Risks of investing in real estate. When investing, the ability to recognize risk is essential. In this section, we'll discuss numerous areas with substantial investing risks. Capital risk. This implies the loss of capital. The downside of an investment is one factor to consider when assessing capital risks. How much money can an investor lose if things start to go wrong? The worst-case scenario can exceed the initial outlay. Capital risks can extend beyond the amount of the initial investment. Did the investor invest 80% of their net worth? If that's the case, there's a major risk involved that could potentially spell ruin. Risk of ruin is a notion in trade. It warns against trading more than X% of your capital to avoid blowing up your account. Real estate investors can use this idea to indicate that putting a sizable portion of net worth into an investment with above-average risk can result in sizable losses. Choosing an exit strategy falls under the capital risk category. Do they have a point at which it is viable to exit the investment if things go against them? Additionally, keeping tabs on spending is essential. What are some potential high-cost yet low-probability expenses? These costs often come under capital expenses, including a leaking roof or a malfunctioning HVAC system. Debt. Real estate investing often uses debt financing. However, the kind of debt financing is crucial. Do you have a non-recourse loan? The lender will then demand collateral seized in the event of failure. Another crucial step is to understand the terms of the debt arrangement. Certain debt covenants may have been included in the agreement by the lenders. If the borrower is unaware of these covenants, they may be violated, leading to unfavorable outcomes. Before applying for a loan, the borrower should have an understanding of what their debt coverage ratio will be. The debt coverage ratio reveals how much debt is repaid through rental income. For instance, a debt coverage ratio of 2.00 applies to a mortgage of $1,000 per month on a house renting for $2,000 per month. A loan covenant may contain a minimum debt coverage ratio that the lender may require the investor to meet. Liability. Ample insurance coverage is required for properties in case someone is injured there. But insurance doesn't always pay for everything. Contracts are crucial for addressing the majority of other issues. Costly legal battles may be avoided with the aid of an arbitrage provision. Additionally, keep in mind that you should budget money for insurance deductibles. Liquidity risk. Even meticulously planned undertakings occasionally don't go as expected. Delays and overruns happen often. An investor might need to discover new financial sources quickly. It's a question of liquidity. How quickly can an investor generate funds for unplanned or urgent costs? arranging a new loan will probably take too much time. It's possible that investors won't invest extra money in a project. Investors can occasionally be the only source of financing. However, liquidity becomes an issue if the investor's whole investment has already been made in the project. This could imply that the investor is forced to sell a portion of her illiquid assets at fire sale rates to raise quick cash. The risk of ruin and the liquidity crisis are strongly intertwined. When liquid resources are depleted, and too much net worth is invested in a project, there is little to no tolerance for error. Market risk. National and local real estate market trends are tied to market risk. All real estate assets within the economy may be impacted if the economy is on the verge of a recession. On the other hand, while the economy can be performing well, local markets might be going through a slowdown. Strong research at the local and national levels can help with this. Consider how a neighborhood will appear in 10 years for a local area. What are the trends right now? Where are crime, market rents, and schools going? Do individuals take care of and upgrade their homes? Property diversification can lessen local market risk but has a limited impact on reducing national market risk. The more properties an owner owns in various areas, the less probable vacancies will impact their overall portfolio. Over-leveraging. Over-leveraging is the practice of borrowing money relative to the value of an investment. Debt is utilized when an investor lacks the capital to invest in a project or when a shareholder seeks to increase returns. Debatable and dependent on each situation, the debt amount is considered excessive. However, an investor becomes over-leveraged when they pile on debt to the point where any cash flow issue could prevent them from making loan payments or raising money to meet a loan-to-value covenant if the property loses value. The amount of debt taken upfront is not necessarily the determining factor in over-leveraging. Depending on the loan kind, it may change. For instance, a loan with an adjustable rate may see payments rise to a level the investor cannot afford. The callable loan may be called if the investor lacks the funds to repay the loan. The investor was over-leveraged in both situations. Investors who use financing should have properties that produce steady, reliable income that can meet the lending costs. Anything else could expose an investor to over-leveraging. An effective risk analysis technique involves ranking the different risks that might occur in a real estate investment. Investors can assess the greatest risk first, and if they find that it cannot be properly reduced, they may reject the project. This is substantially faster than going through a longer, unordered list of dangers. Chapter 2. Market Analysis for Real Estate. A real estate market analysis helps gather information to decide whether to invest in a property or assess the possibility of renting out a city or area. In reality, making such a large-scale purchase without having the necessary information would be insane. Market research is every investor's first step before entering the market. The goal is to confirm that the proposal is feasible and that the existing market accepts it. A thorough real estate market analysis requires patience, which not all real estate investors possess. You must study if you want your real estate business to stand out. So, what does real estate market research entail? What is real estate market analysis? Real estate market analysis, commonly called a comparative market analysis, examines the current market values of properties comparable to the home you want to buy or sell. You must always conduct a real estate market study, whether buying or selling a home. It will help you understand the current market, how much comparable homes are worth, whether it is an investment property, how much you can charge for rent, etc. Real estate brokers and agents produce reports to help sellers set list prices for their properties and, less often, to help buyers make competitive bids. Real estate market research data helps both the seller set a listing price and the buyer determine whether the price is fair. What are the reasons for doing a real estate market analysis? I'll explain why you should always conduct a real estate market analysis, whether purchasing or selling a property. If it's an investment property, this study will also show you how much you may charge for rent and how much houses identical to yours are worth in the current housing market. A real estate market analysis, often known as a CMA, provides data that both the seller and the buyer can use to determine whether the asking price is appropriate. To ensure that buyers and sellers receive a fair bargain based on the worth of the property, a CMA should always be performed. You can accurately determine a home's price by evaluating comparable properties currently on the market. Conducting a market analysis for real estate investments. When conducting real estate market research, you must use a systematic and planned strategy. You can divide your analysis into 4 categories: market, supply, demand, and environment. Next, you must formulate the appropriate questions. The clear goal is to evaluate the market potential and confirm the project's commercial viability. Step 1. Studying the market and its development. It's crucial to first gain a global understanding of the market. The goal is to increase knowledge in this area, including market size, trends, and likely development. Here is an illustration of a list of inquiries to make when researching the market and its expected development course. What is the market's size specifically regarding sales, customers, and turnover? How is the market currently doing? What are the chances for it in the upcoming years? A market may be expanding or staying the same. What are the tendencies in the industry today? Which goods and services are offered on the market? Who are your primary or secondary competitors? What do they provide? How do the products and services you offer and those of your competitors differ or are the same? What are your purchase terms and conditions? What terms and conditions can my potential suppliers provide me, and who are they? By answering these questions, you can improve your understanding of the market position and the players involved. Step 2. Studying the demand. The goals of studying demand are to know the market's consumers and determine whether profit is possible. When assessing demand in a real estate market survey, the following is an example of a list of questions to ask. How many consumers are there in this market? How is this number changing? Is it rising, falling, or staying the same? Who are these customers in real estate specifically? What location are they in? What is the client's rate of consumption? What do they do? What factors influence customer decision-making? What is the spending plan? What factors are crucial for prompting a purchase? Step 3. Analyzing the proposal. The analysis of the proposal entails carefully examining what products and services your competitors currently have to offer. Here is an example of a list of inquiries to think about the offer. Who are the market competitors? Who are the market leaders among the companies? How big are the main competitors? How do they choose their places, and where are they located? How long have they been in business, and how are their finances? What standards are used by certain competitors to succeed more than others? You can find opportunities to plan your future products and acquire competitive advantages by carefully examining your competitors' product lines. A real estate market analysis will give you a deeper grasp of what succeeds, what is necessary for success, and what has failed. Step 4. Studying the environment and the law. The environmental analysis study examines all potential market influencing elements, such as relevant regulations, technological advancements, and other potential influences. Here is an example of a list of questions to ask when researching the environment. What innovations are affecting the market? What is the legal system that controls the market? Are there any laws that are unique to this industry? What patterns can you observe in the development of legislation? Do professional organizations or other actors influence the market? Step 5. The gathering of data. One of the most crucial steps in performing real estate market analysis is data collection, which enables you to obtain details that will enable you to decide if you should buy a property. Start gathering the data you need to protect your investment in the real estate market by conducting real estate surveys. Step 6. Summarizing the outcomes. Investors will be able to conduct an analysis and choose the best techniques to secure the investment by being presented with a report containing the information they have gathered. Real-time data visualization offered by survey software enables you to pre-analyze the information and create a report highlighting the most important information so stakeholders can see it and make better decisions. Make the proper decisions with the help of data to start striking out in the real estate sector. Using data to make informed property investment decisions. Besides being lucrative, the investment sector is also cutthroat, unforgiving, and volatile. You are unlikely to discover its advantages if you are not intelligent, dynamic, and analytical. Real estate is complicated, and numerous risks could have negative, far-reaching implications. Statistics have provided helpful insight into the criteria of what constitutes a successful real estate investment in an era where we have access to a vast amount of data. A significant percentage of the uncertainty in real estate investing is eliminated through property data analysis. To effectively anticipate a suburb's investment potential, it's crucial to consider various sets of statistics because data taken alone can be harmful and easily misread. What are those points then? It's crucial to recognize that understanding when to invest will tell you where to invest before we delve into the specifics of each data set. Location, location, location. This saying about real estate has been repeated repeatedly. However, most first-time investors will focus on the suburbs nearby where they currently reside, which is the incorrect approach. It is essential to adopt a national strategy to gain access to the greatest investment markets. Doing so will provide you access to chances in markets that are at more advantageous points in the property cycle, from the suburbs close to where you live to nationwide markets. Many macroeconomic parameters, such as population growth, infrastructure investment, employment growth, pay growth, future housing supply versus underlying demand, affordability, GDP for the LGA, etc., must be considered to pinpoint these suburbs. Looking more into the facts will help determine when to enter this industry. These factors will dependably show you where to invest. Consider the construction of a train line as an example. When should prices rise as a result? When a project is announced? When it is started? When it is finished? Or 2 years later, when the community is screaming about the decreased trip to work? So how can you choose the ideal moment to invest in a specific suburb? In its most basic form, the real estate market can be divided into 3 categories: buyer's market, seller's market, or equilibrium, as it oscillates between the two. A potential investor can still secure a position in the market by purchasing the transition from a buyer's to a seller's market while also enjoying the price growth that follows as demand rises and the market becomes more favorable to sellers. This transition period won't last for more than 10 to 12 weeks. What kinds of data should one use to spot a market in transition? Days on the market. When analyzing 90-day rolling averages over the previous 4 periods, the pace of change for the suburb's days on market indicator stabilized and subsequently fell, quarter over quarter. The fact that houses sell more quickly after they are on the market shows higher buyer demand. A better understanding of the connection between vendor and market expectations would also be helpful. Simply put, demand exceeds supply. Vendor discounting. When 90-day rolling averages from the last 4 periods are analyzed, the average discounting metric rate of change for the suburb has stabilized and is starting to fall quarter on quarter. This suggests that sellers may be less flexible on their asking pricing with a healthy level of consumer demand. Volumes of sales. When comparing quarterly changes in the suburb's sales volume statistics over the previous 4 periods, 90-day rolling averages showed a constant upward trend. Listing volumes fall in a buyer's market because most sellers hold off on selling until the market is more favorable. When this trend changes, and the criteria, as mentioned earlier, also change favorably, it suggests that more sellers are putting their properties on the market to take advantage of the high level of buyer interest. Gross returns. The rate of change for the suburb's gross yield metric has risen when you compare the measure's 365-day rolling average to its 90-day rolling average. This typically indicates that tenants' interest in a location is growing. Generally speaking, they are prospective buyers, making this a leading indicator of demand from prospective buyers. Rates of vacancy. The vacancy rate in the area is lower than the median value of the long-term, last 5 years, trend line. This suggests a tight rental market, which is crucial for investors because the property must be easy to rent. A sign of this is when supply is insufficient to meet demand. A potential investor should provide a weighting to each score for each criterion. It's vital to consider the data mentioned earlier in context. Even if a suburb is poorer in one particular category, it may still be a wise investment spot. In the end, a sizable percentage of the risk associated with investing in real estate can be eliminated by effectively using the data currently at our disposal. It's likely to find markets at the right cycle point by analyzing significant datasets and statistics, showing an investor where to invest. The leading indicator of location is timing. Buying and holding is still the most secure and effective investing strategy, whereby timing the market is less important than time in the market. I hope you are enjoying my audiobook so far. It would be a pleasure if you could let me know how you are feeling about this audiobook in the comments section below. We would greatly appreciate it if you could also like this video and subscribe to United Audiobooks to have access to more best-selling audiobooks in the future. Also, please, if you are interested in getting more free audiobooks, please click the first link in the description below. Now, let us carry on with the next chapter. Chapter 3: Building a Portfolio of Investment Properties. Would you want to know how you can create a portfolio of properties? Given the abundance of available possibilities, entering this industry is not easy. But because of our unique position in the real estate investment sector and ongoing market analysis, we can navigate investments and build profitable portfolios. Knowing the ins and outs of establishing a property portfolio successfully is crucial if you're looking to do so. This chapter reviews all the information you need to succeed as a portfolio landlord. What does property portfolio mean? An investment property portfolio is a group of assets owned by a person, a group, or a business and used to produce passive income over the long term. This can include real estate rented out to tenants on a long or short-term basis in the residential, commercial, and industrial sectors. The primary goal of investing in a portfolio of buy-to-let properties is to produce passive income for the investor. This can be accomplished by keeping the properties for an extended period, allowing them to increase in value over time, and eventually selling them for a profit. The investor may decide to rent out the properties as an additional means of profiting from their investments. A properly managed investment property portfolio ought to generate consistent income and contribute to wealth accumulation. Even though one investment property can produce a consistent, predictable income, having multiple properties, especially diverse ones, might offer a good cash flow, possibly enabling you to retire early. Developing a real estate investment strategy. Owning a property is an excellent strategy to diversify an investment portfolio with a holding that produces returns equal to those of the stock market but with less volatility. Additionally, residential real estate offers investors special tax advantages, and investors can employ leverage to increase overall returns. There are numerous ways for investors to profit from real estate, even though directly owning investment properties is the most popular. Here are 10 real estate investing strategies experienced and novice investors use. 1. Buy and hold rental property. Buying and holding properties is a real estate investment strategy used to generate rental income, profit from long-term property value growth, and take advantage of special tax benefits available to real estate investors. Over the past 20 years, the median sales price of properties sold in the U.S. has climbed by almost 200%, and the demand for rental housing is still high. Even yet, the net income from rental properties may vary due to upkeep, repairs, or prospective vacancies, and some investors might want a more passive approach to investing. 2. Reinvest rental income. Many buy and hold real estate investors adopt the complementary approach of reinvesting rental revenue. Net cash flow from one rental property is preserved until there is enough money for the down payment on a second rental property, a strategy often known as the snowball effect. Then, until there is enough money for a third rental property, the net cash flow from both properties is saved. The amount of money generated grows as an investor's portfolio of rental properties expands. To pay off a mortgage on a piece of property more quickly, some owners also reinvest rental revenue by making extra mortgage payments. The investor performs a cash-out refinance to convert accumulated equity into cash to buy another rental property once sufficient equity is from combined appreciation and mortgage prepayments. 3. House hacking. One disadvantage of investing in rental property is the potential need for a sizable down payment. A real estate investing strategy called house hacking is utilized by homeowners who don't yet have enough cash to buy a rental home. Rental of a spare bedroom or converting a basement into a studio apartment are two instances of house hacking. Savings from house hacking rentals are used as down payments on rental properties till funds are available. Some investors will also employ a low down payment Federal Housing Administration (FHA) or Veterans Affairs (VA) loan to buy a small, multifamily property. The requirement that the borrower resides in one of the units as their principal residence is one of the potential disadvantages of this strategy. However, residing next to tenants is a great opportunity to learn about real estate investing and obtain practical property management expertise. 4. BRRRR. BRRRR means buy, rehab, rent, refinance, repeat. Real estate investors utilize the BRRRR method to buy fixer-upper properties utilizing short-term financing, perform necessary repairs, rent the properties to qualified tenants, and then refinance and withdraw cash after the properties have a stable history of positive cash flow. The BRRRR real estate investing approach is comparable to the snowball impact in that an investor repeats the same action. BRRRR is typically a more advantageous option for an active investor with the time and expertise to complete tasks or who has a reliable, cost-efficient network of handymen and contractors to assist with renovating. Short-term financing often entails high loan fees and interest rates, so an investor should be careful not to run out of cash until the property starts to cash flow. This is one disadvantage of BRRRR. 5. Fix and flip. If everything goes according to plan, house flipping is a high-risk real estate investing technique with a potentially high payout. Since they only intend to hold a property briefly, investors who fix and flip properties do not want to be landlords. A flipper may hold on to an undervalued property and hope to profit from appreciation after finding and buying it. Alternatively, they may undertake strategic improvements to boost the property's value. Investors who cannot flip a home quickly or underestimate the cost of renovations may run out of money. Fixing and flipping is best suited for those with substantial experience in determining the fair market value of a house, the actual cost of renovations, and enough funds to complete the project on schedule and under budget. 6. Real estate wholesaling. Real estate wholesaling is a version of fixing and flipping, an investment technique in which the wholesaler never takes over the property. As an alternative, a real estate wholesaler looks for a distressed property with an inspired seller, contracts the house at a discount, determines the cost of repairs and the property's final fair market value, and then assigns the purchase and sale agreement to another investor in return for a small wholesale fee. For real estate wholesaling to be effective, it takes a lot of effort, market expertise, and strong negotiating skills to persuade an owner to sell their home for less than the fair market value. In many states, a property wholesaler must also have a license. Real estate wholesaling could be a good investment plan for those with limited investment capital. Some seasoned real estate wholesalers employ real estate bird dogs to find a distressed property, and when the property is located, they give the bird dog a small referral fee. 7. REIGs. Small funds called real estate investment groups, REIGs, buy groupings of rental properties and then let investors purchase those properties from the group. The REIG manages the marketing of vacant properties, tenant screening, rent collection, property management, and maintenance in return for a portion of the monthly rental income. When the properties in the group are sold, investors in an REIG profit from their shares of any equity growth and recurring rental income. People searching for a hands-off real estate investing strategy can find an REIG a viable alternative. Still, it's important to examine management and their prior record of success or failure. 8. REITs. Real estate investment trusts, REITs, invest in various real estate assets, including commercial real estate, residential build-to-rent, BTR, subdivisions, or special use properties like data centers and cold storage facilities, which can be publicly or privately held businesses. At least 90% of REIT's profits must be distributed as dividends to shareholders. They can be a useful strategy to diversify a portfolio of investments to make money from real estate without owning any real estate. Long-term leases with credit tenants are usual for investment-grade assets owned by a REIT. Publicly listed REITs are more liquid than other real estate investments because their shares can be purchased or sold on an exchange. REITs, however, don't offer some of the benefits of directly owning a rental property, such as having direct control over decisions regarding property management. 9. Crowdfunding. Online real estate investment platforms called crowdfunds allow investors to pool their cash to purchase shares of premium commercial and residential properties like newly constructed homes, apartment complexes, and commercial real estate that have been stabilized. Crowdfunding can be a great method to get exposure to properties that are out of reach for most investors. If a project is lucrative, crowdfund investors will get regular pro rata distributions of net income along with a portion of any profits. Shares often have lockup periods until a project is stable or during economic instability, which is one of the disadvantages of crowdfunding. To find profitable prospects, finance and build the project, and lease and manage the property to increase asset value and cash flow, investors must also rely on the experience of the crowdfund sponsor. 10. Private lending. Private lenders finance real estate loans instead of investing in stock. Private lenders give money to real estate investors looking for an alternative to conventional financing sources, such as home flippers, instead of buying rental property. Like a typical bank, private lenders generate income through lending fees and interest rates. But generally speaking, costs and interest rates are higher. Even though private lending might be a wonderful strategy to earn consistent interest revenue, there is a chance that a borrower would default, and the lender will have to take back a partially refurbished home. Because of this, private lenders have real estate investing knowledge and know how to safeguard themselves if a property needs to be foreclosed. 8 steps to build a property portfolio. Even if you are familiar with real estate investing, managing tenants, diversifying your holdings, and growing a portfolio may overwhelm you. Real estate portfolios are a long-term investment strategy that can generate consistent income when used properly. Here are our top recommendations for beginning, expanding, and maintaining a real estate portfolio. 1. Market research and advice seeking. Knowing the kind of properties available, which areas are in demand, and how much you'll need to invest is one of the first stages to developing a solid portfolio. Prioritize your study before investing to ensure you thoroughly understand the costs and value they will add to your portfolio. When you are planning, you should do research in the following areas. The available property strategies. It's crucial to realize that many variables affect which path to take as you evaluate the property as an investment option. What you choose to invest in will be influenced by your financial status, goals, time horizon for your investments, and preferences. First, decide whether to invest in commercial or residential property. Then do additional research on HMOs, build to rent, social housing, and student housing in the buy-to-let industry. Find out which strategy would reduce risk and guarantee the best return on investment over time. Tenant type and rental demand. Before promoting a rental property, consider rental demand and the sort of tenants. Do you want tenants who plan to move out after a few months, or do you want them to stay for the long term? Is the location of your business in a hip neighborhood that draws young professionals, or is it in a more residential region that welcomes families? Once you've determined the kind of tenant you want, it's essential to consider the local facilities and transportation options. The likelihood of void periods decreases as the area becomes more populated. Purchase price and ongoing expenses. Before investing in a buy-to-let property, ensure your finance options will cover all expenses associated with maintaining, repairing, and remodeling the property, including the purchase price and ongoing expenses. Additionally, fees like stamp duty, insurance, taxes, property management firms, estate agents, and more must be considered. Your affordability will be easier if you consult a financial counselor. Rental yield hotspots. To ascertain possible rental income, a landlord must examine the average rental yield in the chosen city. The annual rental income from a property is calculated as the annual rental income divided by the annual property value. With the help of this information, you can decide what kind of real estate would be advantageous for you to buy and rent out. You should also look into the neighborhood's average house and rental costs to ensure solid returns and a high chance of capital growth. 2. Establish long-term goals and plans. Before deciding to purchase your first rental property, considering your long-term objectives is good. Do you prefer to profit from capital growth when you sell the home instead of monthly returns from rental income? You might need to keep your property for a very long time, renting it out during that time, to see its value rise. The time you must devote to your real estate firm must also be considered. If there is a vacancy, decide if you want to be a hands-on landlord that addresses maintenance concerns, looks for renters, and collects the rent. A lettings and management agent can also take care of it for you. You can concentrate on your current job, business, or retirement goals. Don't forget to consider your legal responsibilities as a landlord and any potential buy-to-let taxes. 3. Build your portfolio gradually by starting small. When starting your path into real estate investing, nothing is more crucial than making a sensible choice for your first property. Acquiring several properties at once can be tempting when buying your first home to maximize your return. But starting cautiously and with much thinking is important to build a sizable portfolio over the long run. For new investors, a low-risk option is best. You'll have a better chance of succeeding as a landlord and expanding your portfolio rapidly if you choose a property that needs little upkeep or repair. 4. Consider a limited firm. When you own multiple properties, you can discover that becoming a limited company is better for tax payments. Company taxes are lower than individual taxes due to higher income tax rates. This implies that by setting up a limited company, you may keep your profits inside the business and use them to pay for future purchases without paying income tax. Because they receive more tax liability protection, many landlords elect to register their properties as limited companies. If you sell one of your buy-to-lets, you won't generate a capital gain if you retain profits within the company, avoiding capital gains tax. 5. Buy off-plan housing. For several reasons, investing in buy-to-let real estate off-plan is worthwhile. First, once construction is finished, the property's worth from the planning stage will probably increase. You can take advantage of this boost in value if you purchase right away rather than waiting until construction is complete. Second, purchasing property before development is complete allows you to bargain with the developer for a better value. You might get discounts on investments or more enticing terms as a result. Lastly, purchasing off-plan real estate enables you to lock in your investment before anybody else, decreasing the likelihood that another party will acquire it before development starts. 6. Employ a property manager. The management of your rental properties can get onerous as more obligations pile up while you seek to expand your real estate empire. The requirement to hire third-party property management increases as your portfolio expands. This helps ensure that all responsibilities under the law are fulfilled and that all tenants and properties receive the required degree of care. One of the duties of a property manager may be to organize and supervise maintenance and work orders, hire contractors to complete maintenance work and repairs, handle tenant complaints, effectively market vacant properties, arrange viewings and paperwork for new tenants, and collect rents into your account. Property managers often get between 8 and 12% of your rental income. While employing assistants may lower your overall returns, it may also allow you more time, the opportunity to purchase more properties, and time freedom. 7. Scale back your real estate investment holdings. Once you've acquired control of your first property, begun to generate a reliable income, and established yourself as a pro in the real estate investment business, it's time to expand your stock of real estate holdings. You can buy land, convert buildings, multi-unit buildings, off-plan homes, or completely new construction. You should consult your investment counselor and accountant to choose the appropriate second home. You can grow quickly with the help of financial solutions. Joint ventures and partnerships are a dependable and efficient way to access another person's contacts, resources, and expertise, enhancing your real estate firm and your potential to scale. Additionally, requesting property financing may enable you to find your desired investment properties. 8. Have a backup plan, an exit strategy. Investing in real estate without a plan for exiting the investment can be risky since it increases the likelihood that you won't see significant returns or get back as much as you put in. An exit strategy is implemented to lessen the likelihood of failure and to limit risks. It gives investors a specific aim or target to strive for, directing their investment timetable and financial projections. Some of the most popular escape tactics are listed below. Time-based approach. This exit strategy involves selling a single property or several properties after a predetermined number of years. This is advantageous for individuals intending to sell as they get closer to retirement. Still, investors should consider potential tax obligations arising from the sale. This will change the total profit from capital appreciation. Value-based approach. Investors may decide on a target they want to achieve in terms of value rather than time. Once a property reaches a certain value, it is sold to make room for other, more expensive investments. To plan for value rises or losses, this technique necessitates routinely monitoring tenant demands, market movements, and property predictions. Yield-based exit strategy. When you intend to sell a property when the average yield falls and no longer delivers enough returns, you employ a yield-based exit strategy. This technique can be used on any property. However, multi-unit residential and commercial properties perform best. The time to sell arises when yields fall under a specific cutoff point. Chapter 4. Real Estate Investment Trusts, REITs. Any equities or fixed income portfolio should consider real estate investment trusts, REITs. They can offer greater diversification, higher possible returns, and less overall risk. In brief, they are a great counterpoint to stocks, bonds, and cash since they can produce dividend income and capital growth. Real estate investment trusts are involved in REIT investing. Commercial assets that generate income are owned and managed by REITs, whether the actual properties or the mortgages securing them. You have three options for investing in REITs: through the firms, exchange-traded funds, or mutual funds. There are numerous varieties of REITs. Here, we examine some major REIT categories and how to invest in them. By the end of this chapter, you should know more about REIT investing in general, as well as when and what to buy. What is a REIT, Real Estate Investment Trust? If you're not sure what REIT investing is, it's a collective investment plan that enables investors to buy shares in a portfolio of real estate assets that generate income. In case you were wondering, REIT stands for Real Estate Investment Trust. Real Estate Investment Trust is a business that manages, owns, or funds any income-producing real estate. Co-working spaces in the gig economy age illustrate this, where, like mutual funds, REITs pool multiple investors' capital. This shares the investments and dividends without needing individual management, as opposed to direct investment in real estate, such as purchasing a commercial property. REIT enables investors to have substantial exposure to real estate assets. How do REITs work? Depending on the REIT's classification, investors can select from a wide range of real estate funds, including equity REITs and mortgage REITs. Equity REITs own properties like hotels, stores, offices, condos, and other real estate types, whereas mortgage REITs get their money from mortgage-backed securities or interest on the assets. In essence, REITs rely on infrastructure development, structured governance, and encourage domestic and international investment to help smooth and speedy liquidation of your real estate investments. How to invest in different types of REITs. Investors have many possibilities when choosing a REIT for their investment portfolio. Before investing, it is essential to understand the many types of REITs that are accessible and their features. Investors can invest in three primary types of REITs in addition to the three classifications of REITs. Each type serves a different purpose and could offer various advantages. The various kinds of REITs include: 1. Mortgage REIT, MREIT. One of two approaches is used by a mortgage REIT, or MREIT, to finance real estate assets. Mortgages and other types of real estate loans are one way that some MREITs provide direct financing. Others buy or create mortgage-backed securities, MBSs, asset-backed securities made from collections of mortgages. Banks offer loans packaged as MBSs to MREITs or other investors. MREITs can obtain their mortgages or securities through various funding sources, such as repurchase agreements and structured financing. In neither of these agreements, the MREIT owns no actual real estate assets. Instead, the interest on its investments provides the income. Mortgage-backed REITs, MREITs, lend to other people to help them buy, build, and own commercial real estate that generates revenue. Investors receive a proportionate share of the MREIT's profits after its operating costs and finance charges have been met. residential mortgages, commercial mortgages, residential mortgage-backed securities, RMBSs, and commercial mortgage-backed securities, CMBSs, are just a few of the real estate assets that MREITs can invest in. Although some MREITs also engage in RMBSs and CMBSs, most participate in residential or commercial mortgage offers. MREITs generate income while assisting the real estate industry by charging interest on the money they lend to borrowers financing their acquisition of residential or commercial real estate properties. Mortgages created by REITs may be sold to banks, investors, or the government. Investing in a mortgage REIT, a guide. Investors thinking about MREITs need to be aware of several variables that could impact their investment. Interest rate risk. The net interest margin of an MREIT, which is the difference between the revenue from interest on its mortgage assets and its funding expenses, can be impacted by changes in interest rates. If MREITs retain fixed-rate mortgages among their holdings, rising interest rates can significantly reduce the value of those securities. To control their interest rate and credit risks, several MREITs use hedging strategies, including interest rate swaps, caps, or floors. Thanks to these strategies, investments in MREITs can be less risky. Volatility. MREITs may be more volatile than other REIT forms regarding price swings. Variations may influence this volatility in the net interest margin of the MREIT. However, when the spread is wide, MREITs may have a significant yield potential. MREITs can be privately held, publicly traded, or publicly non-listed. Shares of MREITs may also be purchased by investors via a mutual fund or exchange-traded fund, ETF. Here is how each of these channels might allow investors to purchase shares of MREITs. Stock exchange. Publicly listed MREITs are available to real estate investors on the main U.S. stock exchanges. Since they are SEC-registered REITs, they must publish financial statements regularly so that investors can evaluate their yields and general performance. A financial advisor or broker. Investors interested in purchasing publicly traded, non-listed MREITs may do so through a broker or financial advisor participating in the REIT's offering. A few brokers provide accredited investors with private MREITs. ETF or mutual funds. Investors can purchase MREIT shares through a mutual or exchange-traded fund, ETF. 2. Equity REIT, EREIT. An equity REIT, also known as an EREIT, makes investments in real estate and makes money by collecting rent from tenants. Commercial or residential real estate is an investment option for EREITs. During their business operations, EREITs carry out several tasks, such as maintaining, improving, and managing their real estate holdings. Property managers who work for EREITs often manage these physical assets for investors. As a result of this structure, EREITs are passive investments that have the potential to produce large returns through rental revenue. EREITs use rent payments to cover running costs for their properties and the payments of their property managers. The EREIT's net income is subsequently distributed to investors as dividends. Like MREITs, EREITs must distribute at least 90% of their net income to investors. The selling of properties is another source of revenue for EREITs. Capital gain distributions are how the EREIT pays revenue to investors when it can sell a property for a profit. Depending on the investor's income category, the IRS levies capital gains taxes at 0%, 15%, or 20%, lower rates than those of ordinary income. Many prospective real estate investors would picture EREITs when considering a REIT. These REITs contribute to funding initiatives that foster job growth, enable necessary services, develop infrastructure, and support economic growth. These REITs can be a good fit for a long-term investment strategy, such as one centered on retirement savings because they rely on rental payments for income. Warehouses, shopping centers, office buildings, hotels and resorts, senior living facilities, self-storage facilities, manufacturing facilities, and apartment complexes are just a few of the real estate assets that REITs invest in. Investment guidelines for equity REITs. Real estate investors who are considering REITs can find it useful to take into account a few characteristics specific to this kind of REIT that could influence their investment approach. Constant operational expenses. The REIT's revenue may be impacted by the expenses related to leasing and managing residential and commercial properties. Possibility of real estate appreciation. These properties might also experience long-term growth due to real estate appreciation. Even while market swings impact property value, investors may see a consistent increase in the value of an REIT's properties over time. But for REITs to profit from appreciation, a property must be sold. Investors have little control over the process of real estate appreciation on the properties because the REIT manager is in charge. Potential for huge income. Rental income from REITs can be very lucrative, depending on the market and the chosen investment strategy. Potentially less volatile than REITs. REITs are more common than REITs because they deal with actual real estate instead of mortgages and may be less impacted by market and economic situations. Due to their very low correlation with other assets like stocks and bonds, REITs can also help investors diversify their portfolios. REITs might be private REITs, PNLRs, or publicly traded REITs. Some REITs are specialized and concentrate only on assets from particular industries, such as self-storage facilities or the healthcare industry, while others are more diversified. Some REITs concentrate on particular investment strategies. One strategy would involve purchasing real estate buildings, for instance, that require construction or renovation before they can be rented to renters. Another strategy might be allowing only an REIT to purchase fully occupied, income-producing buildings. Depending on the REIT type they pick, investors may invest in an REIT in the following ways. Stock exchange. Just like when buying shares of a publicly traded company's stock, investors can purchase shares in a publicly traded REIT through a national securities exchange. The financial reports that these REITs file with the SEC allow investors to examine the performance of these entities. Financial advisor or broker. If investors want to purchase public, non-listed, or private REITs, they must do so through a broker or financial advisor. ETF or mutual funds. Investors can also buy shares of REITs listed on the stock exchange through a mutual fund or ETF devoted to REITs. 3. Hybrid REIT. REITs and MREITs are combined to form hybrid REITs. Hybrid REITs employ the investment strategy of purchasing both real estate and mortgages. While they still buy both types, hybrid REITs often invest more heavily in one type of investment than the other. These REITs have more latitude to adjust their portfolio allocation in response to shifting interest rates, market conditions, and property values. By using hybrid REITs, investors can gain from holding REITs or MREITs while reducing total investment risk. For instance, rising interest rates and falling property values are the main risks related to REITs. Falling interest rates may also have a detrimental effect on the revenue MREITs get. Investors may be able to avoid some of the risks associated with each form of investment by making investments in hybrid REITs, where the REIT management actively manages the portfolio's diversity in response to these changing conditions. A hybrid REIT is required to cover finance costs for its investments in mortgages and MBSs and operating costs for its rental properties. Hybrid REITs must also pay out at least 90% of their net income as dividends to investors, just like MREITs and REITs are required. Depending on the REIT manager's strategy, these REITs may invest in a mix of the following assets: manufacturing buildings, self-storage facilities, senior living facilities, apartment buildings, healthcare facilities, office buildings, shopping malls, residential or commercial mortgages, residential or commercial MBSs, senior living facilities, and self-storage facilities. Investing in a hybrid REIT. A guide. Investors may participate in hybrid REITs if they are unclear about the real estate assets they want to invest in, or want the REIT manager to manage the REIT's portfolio as market conditions change actively. Hybrid REIT's ability to engage in real estate assets and mortgages may appeal to some investors. The individual investor's investment goals and approach ultimately determine whether to invest in a hybrid REIT. The possibility of sector-specific investing is crucial for investors to consider when determining whether to invest in a hybrid REIT. In particular real estate market segments, such as residential or commercial assets, hybrid REITs can make investments. A hybrid REIT, for instance, might decide to invest in residential real estate, residential MBSs, and residential mortgages. Investors can select the hybrid REIT that best meets their needs. A hybrid REIT investment is comparable to an EREIT or MREIT investment. Stock exchange. A national securities exchange is where prospective investors can find shares of publicly traded hybrid REITs. Financial advisor or broker. Brokers or financial advisors are used to sell publicly traded, non-listed hybrid REITs. Through this route, accredited investors can also purchase shares of hybrid REITs. Chapter 5. Rental Property Management. One of the most significant choices an investor has to make when a rental property acquisition is completed is how to manage the property. While some landlords elect to outsource property management fully, others may do it themselves, DIY. Even though it might seem intimidating, it is possible to manage a home alone. This chapter examines a do-it-yourself landlord's primary duties and the 6 steps to managing a rental property. Management options for rental properties. Investors in real estate are never without options, and managing a rental property is no exception. There are 3 methods of property management that landlords might use. Managing a property yourself. Self-management of a rental property is often chosen by landlords with more time on their hands. For owners who struggle with delegation, doing their property management can be a viable solution. However, managing tenants can become stressful, and breaking fair housing and landlord-tenant regulations might result in a lawsuit against the landlord. Pay for management services. Some property management firms allow landlords to select services they want to contract. To help a do-it-yourself landlord market and show a vacant property, screen a potential renter, and sign a lease, several managers, for instance, offer a leasing-only plan. Pay-as-you-go property management may be effective for some landlords, but if the owner has a full-time job or lives in another state, it may be challenging to manage a rental property. Employ a property manager full-time. Choosing not to do it yourself is the third choice. Hiring a competent local property manager to handle day-to-day concerns, including tenant contact, maintenance and repairs, and legal difficulties, may be worth the monthly charge. Typically, a property management company will charge a monthly fee of 8% of the monthly rent. Many landlords consider that a negligible cost to pay to avoid the hassles of self-managing a property. Responsibilities of a DIY landlord. Some landlords are capable and manage their rental property. Here are the 3 broad areas of duty that DIY landlords should be aware of before deciding to do it alone. Tenant management. Tenant management demands a high level of interpersonal skills. Naturally, tenants want to believe that their money is being well spent. Landlords should be able to manage tenant concerns politely while setting limits on unreasonable requests, such as paying the rent after the due date without incurring a late fee. Keeping tenant turnover low and maintaining a healthy cash flow occasionally feels like a delicate balancing act. 3 legal facets of managing renters include understanding how much notice is necessary before accessing the property, being aware of state landlord-tenant legislation, and abiding by the Fair Housing Act. A violation of the law could result in hefty fines or perhaps legal action from the renter. Property management. For the benefit of both the renter and the area, landlords must keep the property safe and livable. An effective strategy to find minor problems before they become significant, expensive repairs is to do proactive property inspections. For instance, Seasonal maintenance of the heating and cooling system and gutter cleaning before the start of the rainy and snowy seasons may help to prevent costly repairs totaling thousands of dollars. Another duty of self-managing a rental property is to complete a move-in and move-out checklist with the tenant. It is easier to distinguish between regular wear and tear and abnormal damage if the house's condition is documented before the renter moves in and at the end of the rental agreement. Many states permit a landlord to keep back a portion of the tenant's security deposit to cover any damage the renter may have done. Financial management. Real estate investors buy rental property to make money, ideally every month. Managing the money by keeping track of every dollar earned and spent is one of a DIY landlord's responsibilities. The appropriate line item on the chart of accounts must be credited with rent payments, late fees, and security deposits. The same holds for the landlord's payment of utilities, property taxes, insurance, repairs and maintenance, and other running costs. How to manage rental properties. Let's now examine how landlords might effectively manage their rental properties. Here are 6 steps to self-manage a rental after buying a house and making it rent-ready. 1. Identify the reasonable market rental rate. It may appear to be an art and a science to determine the ideal rent. A rent price that is too high will deter potential tenants, while a rent price below the market can lower earnings. The area's median household and per capita income, prospective tenants' demographics, such as whether they are singles or families, the median rent being charged by the competition, and property features that would justify a higher rent, like a big garage or a neighborhood pool, are all things to take into account when setting the rent. To get rent comparisons for a home, use one of the many web services available. By establishing a fair asking rate based on recent listings, rent comparables, and market trends, they can spot possibilities to boost cash flow. 2. Market the vacant house. Many investors and property managers use online rental listing and tenant screening services created specifically for do-it-yourself landlords to discover appropriate tenants. With the help of websites like Avail and Rent Tech Direct, landlords can create a rental listing, automatically syndicate listings to the top online rental listing services, receive leads from potential tenants directly, offer online tenant applications and screening services, request credit, criminal background, and evictions reports while charging the applicant for the service, and create and sign a tailored lease for the state where the rental property is located. After choosing a tenant and signing a lease, the next phase is to collect the security deposit and first month's rent and meet the tenant at the rental property to finish a move-in checklist. 3. Inspect and maintain the property. The landlord's duties begin once the renter moves in. There will be maintenance and repair issues, and the sooner they are resolved, the happier the renter will be and the more likely they are to renew the lease. It can be a good idea to drive by the property sometimes without disturbing the tenant to check for exterior damage. It is beneficial to regularly inspect the inside and outside of the rental property after providing the renter the required notice to identify little problems before they become significant and expensive. Lastly, completing yearly maintenance on the roof, heating and cooling system, water heater, and appliances can help keep capital expenses under budget and extend their useful life. Many do-it-yourself landlords create a list of things a landlord or low-cost handyman can fix. Create a list of insured and licensed contractors to service the plumbing, electrical, and HVAC systems. Ask nearby fellow landlords for recommendations of dependable vendors, and regularly contribute to an emergency fund or CapEx, capital expense, account to prevent having to go into debt. These steps help streamline repairs and enable landlords to respond to maintenance requests from tenants more quickly. 4. Collect the rent and uphold the terms of the agreement. Investors buy rental property to earn money, and making money starts with timely and full rent collection. Many DIY landlords use online rent payment platforms like Tenant Cloud and Cozy for same-day rent collection with any processing fees paid by the renter rather than waiting for the check to arrive in the mail. Increasing rent collections is an excellent motivation for landlords to accept payments online. Most tenants prefer to pay their rent online and are more likely to do so. Do-it-yourself landlords should be ready to impose any late fees specified in the lease if a renter fails to pay on time. It's likely that if a tenant develops the practice of paying late without incurring a fee, they will continue to do so. Due to the landlord's cash flow issues, a landlord may have to evict a tenant who routinely pays late. 5. Evict rent defaulting tenants. Even with the best tenant screening procedure in place, evictions are occasionally necessary for landlords. Depending on the situation, the property is located in the city and state. A residential eviction may cost $3,500 or more and can take 4 weeks or more to complete. A landlord may have to repair significant damage caused by the tenant after they vacate since no rental income is coming in. Some landlords take a practical approach and pay a renter cash in exchange for returning the keys and leaving the property rather than throwing good money after bad. Though it may seem illogical, cash for keys is used to avoid an expensive eviction and immediately restore the rental property's income flow. 6. Utilize a reliable accounting system. The ideal accounting system will create accurate financial reports, including an income statement and a net cash flow report, and a system for keeping track of receipts and other paperwork for a paper trail. Chapter 6. Flipping properties for profit. Flipping is buying an asset to quickly sell it for a profit, rather than keep it for long-term appreciation. Flipping is often used to describe some investors' actions in initial public offerings, IPO, and short-term real estate transactions. Flipping can usually refer to purchasing an asset intended to be sold for a profit, including vehicles, cryptocurrency, concert tickets, and other items, even though these are the most common use cases in the finance industry. How flipping works. Real estate is where flipping is most often used to describe buying properties and swiftly, usually less than a year, selling them for a profit. Flipping typically refers to one of two forms in real estate. Real estate investors who seek properties in quickly appreciating markets and resell them with little to no extra investment in the physical property fall under the first category. Instead of the property itself, this is a play on the current market conditions. The second category is a quick repair flip, or reno flip, when a real estate investor uses his understanding of what buyers desire to raise the value of undervalued properties by renovations and cosmetic adjustments. Finding properties to flip. If you're keen to begin this project independently, your first concern is presumably, how do I discover a property to flip? This section discusses several factors to consider when looking for your first flippable home, including what to look for and try to avoid. Flipping homes is one of the more well-liked strategies to generate income flow in real estate investing. Finding a house to flip might be difficult, even though it can be profitable. Here are a few of the finest ways to locate a house to flip. Make use of a real estate agent. First, finding a real estate agent that understands your industry is crucial. Ideally, this person will be knowledgeable about real estate investing strategies, especially house flipping. The Multiple Listing Service, MLS, which provides you with a list of affordable properties like foreclosures and short sales, is accessible to real estate agents. Recognize your target market. One of your first steps must be to identify your target market to locate possible houses to flip. The goals are to find a fantastic deal on a house that needs work, do the work, and then sell the house for at or over market value. These communities are often developing regions with amenities, including public transportation, entertainment venues, shopping areas, dining options, affordable housing, and top-notch educational institutions. Examine nearby auctions. When a lender forecloses, the property is typically sold at auction. You can access online public information about these auctions. The date and hour of the auction should be mentioned in the listing. It's one of the easiest methods to find a house to flip at a decent price, but you'll need cash to buy the property at the auction. If you use this strategy, remember that you might not have enough time to inspect the house before placing a bid. Consider coming early if the auction allows prospective buyers to tour the house first. Before the auction, you can also drive by the property and make a visual assessment. Look for foreclosures. A house becomes a real estate-owned REO property if it doesn't sell to a bidder at auction. This means that the lender regains possession of the property. Remember that considerable cleaning and repairs may be required for the house. Check short sales. The lender may consider a short sale if a homeowner needs or wants to sell a home that isn't worth what is owed. This indicates that the house is sold to a buyer for less than the outstanding mortgage. Even though the house might require significant repairs, these homes can be a good investment for real estate investors. For instance, if a homeowner lacks the financial means to purchase a home, they will also be unable to afford the essential upkeep. Short sales are accessible on the MLS. Other choices. Try to drive through desirable neighborhoods while looking for properties that appear vacant or need repair. Find the owner using public records, then write to them to express your interest in the property. Some homeowners are eager to sell but are unaware of the potential value of their homes to investors. Renovating properties for maximum profit. Here are some recommended practices to increase the value of your real estate investment, whether you're fix and flipping the home or using a buy and hold approach to generate passive income. Concentrate on rooms with high value. Focus on remodeling lovely kitchens and bathrooms instead of finishing basements or expanding closet spaces and attics, since people spend most of their time here. If rewiring is necessary during a normal full kitchen makeover, which includes cabinet replacement, there may be delays and higher costs. To get around this, you may reface the cabinets with new doors and update the appliances, hardware, countertops, and backsplash, costing you less than half as much as buying and installing new cabinets. Reconsider hardwood floors. Even though many individuals choose hardwood flooring over carpet, the extra cost of labor and raw materials may push your flooring budget beyond $20,000, making it an unaffordable choice for many investors. The price of brand new hardwood flooring can range from $3 to $8 per square foot, depending on the size of the house. Modern vinyl flooring can be installed any place in the house, including the kitchen, bathrooms, living room, and more, if the property's current flooring cannot be salvaged. Due to its ease of cleaning and durability, vinyl may be preferred by prospective homeowners and tenants over hardwood. Details matter. Consider how you can use the property's current characteristics to increase value rather than replace everything on it. While you are likely to repaint the entire house for a more contemporary appearance, think about these high-impact improvements. Swap out all of the light switches and electrical sockets for ones with the same finish and color. Update all of the hardware. Consider the all-black trend to cut down on material costs and prevent mismatched finishes. Add features like a home security system or digital doorknob, and more. Upgrade the curb appeal. An updated property's curb appeal goes a long way to attract visitors to the home, whether you're preparing to sell or rent it. Buyers will spend 7% more on a home with upgraded curb appeal than a neglected facade. Update your house numbers and mailbox. Touch up the exterior paint or think about adding stone veneer to the front. Paint the current front door a new color and replace the hardware. Spruce up the patio or add an outdoor fire pit, and tidy the landscaping and front porch. You can make these few high-impact exterior updates to your investment property. How to start flipping properties. Comparing buying a turnkey rental property to flipping a house involves certain differences. To buy cheaply, you must have a solid understanding of market patterns. You also need to foresee the price of selling the property while still earning a profit. To flip a house, you must take the following 5 steps. 1. Market analysis. It's far easier to say than to do to buy low and sell high. When flipping a home, you need to pick a property with enough upside potential after deducting the cost of renovations to turn a profit. Generally, middle-class and working-class properties in 2, 3, and 4-star neighborhoods are the greatest places to find a house to flip. 2. Cost estimates for updates and repairs. Successful home flippers concentrate on properties requiring minor cosmetic improvements, such as new flooring or paint, updated plumbing fixtures like sinks and faucets, and stainless steel appliances, compared to solving structural issues like a damaged wall or foundation, which call for using a qualified general contractor and obtaining licenses from the city. Estimating repair costs like these is considerably easier. The 70% rule is used by real estate investors who flip properties for a living to determine the highest bid price for a residence. To determine whether a bargain makes sense, you must know the cost of repairs and the after-repair value, ARV. The maximum offer price for a home that is being flipped can therefore be calculated using the following formula. Maximum offer price equals repair cost minus 70% of ARV. If the ARV of a house you're thinking of flipping is $150,000 and the required repairs cost $15,000, the highest offer price you could make is $90,000. Maximum offer price, $90,000, $150,000 ARV times 70% equals $105,000 minus $15,000 repair cost. 3. Finance arrangements. Using all your money or obtaining a short-term hard money loan are viable methods for financing a house flip. Conventional buy and hold real estate investors typically use leverage to boost total returns. House flippers, on the other hand, strive to enter and exit a deal fast and avoid accruing debt or paying interest because doing so could reduce their prospective upside gains. Additionally, because of the perceived higher risk, most conventional lenders won't offer a loan on a home that is being flipped. Get to know contractors. When you let contractors, handypersons, and material suppliers know you'll be bringing in a steady stream of business, they'll typically offer you better rates. You can lower the possibility that the cost of repairs will be more than anticipated by developing a network of reliable and affordable contractors. The purchase price plus the cost of repairs exceeding the home's fair market value is one bad thing that can happen when flipping a house. If that occurs, you'll have to flip the house at a loss, which no real estate investor likes to do. 5. Purchase a house to flip. The next step is to place the home under contract once you have properly examined the neighborhood real estate market and have discovered a property that would make a profitable flip. Because you're offering below market value, sellers will anticipate a purchase agreement with few conditions and a quick escrow close. The day escrow closes, have your team of contractors prepare to start making repairs. The sooner you complete the updates, the sooner you can sell the home and earn money. How to maximize sales profits. An owner-occupant who will gladly pay more for a great property, entirely remodeled and updated, is one strategy to sell a house you are flipping. To do that, you'll probably need to put the house on the local MLS and pay a 5% to 6% real estate agent commission, which will reduce the profits from the house you are flipping. Renting the property out to a renter is a smart move to make the most of your prospective income when you flip a house. You must perform a thorough tenant screening and season the renter by ensuring the rent is paid on time every month for several months. The house can then be listed on the Roofstock marketplace and marketed to eligible real estate investors as a turnkey rental property. Sales commissions are roughly half of what you would pay through the MLS, and investors in rental property could be willing to pay more for a house that has undergone extensive renovations and is occupied by quality renters. Although this method of selling will extend the period between purchasing and flipping the home, the rental money from the renter will help cover the costs of keeping the home for a few more months. Do the figures using both scenarios to determine whether the money you will realize selling on Roofstock is more than selling on the MLS. Chapter 7. Taxation and Real Estate Investing. You might desire to invest in real estate for a variety of reasons. When a home's value rises over time, it can provide money through appreciation, and if you rent it out, it can generate passive income. Additionally, it's a useful approach to diversify your investment portfolio. Tax advantages of real estate investing include deducting some expenses for rental properties. Real estate taxes, however, may be quite complicated, just like everything else related to the IRS. The tax implications of real estate investing are examined below, along with the main tax advantages to remember. What types of taxes is real estate subject to? Whether you are a property owner or just an investor, the types of taxes you will be exposed to when dealing in real estate may vary. As an illustration, if you own a house or apartment and rent it out, you'll have to pay property taxes to your local or state government and income and capital gains taxes if you ever decide to sell the property for a profit. This is significantly dissimilar from purchasing real estate through a real estate investment trust, REIT, limited partnership, RELP, or crowdfunding. You pay individual income taxes, which don't require you to deal with the burden of owning a home. Here is a summary of the many taxes you may incur if you own or invest in real estate. Property taxes. State and municipal governments levied property or real estate taxes annually to help pay for roads, schools, police and fire departments, and other state and local services. The assessed property valuation, which includes the land, buildings, and other improvements, is typically the basis for calculating property taxes. Property tax rates may vary depending on your city and state. Net investment income tax, NIIT. Interest and dividends are examples of investment revenue from some real estate investing strategies. If you earn a lot of money from investments and are a high earner, you will have to pay NIIT, which the IRS levies at a rate of 3.8% to certain net investment income. According to information provided by the IRS on its website, who must pay this kind of tax depends on filing status and modified adjusted gross income, MAGI. Real estate income tax. Real estate rental income is determined passive income and is subject to ordinary income tax. Take the material participation test to discover whether you actively participated in a business or whether it is passive income to ensure that you fit the IRS's definition of what is deemed passive income. Business income tax. Real estate rental can occasionally be considered a trade or business. This only occurs if you offer services beyond the bare minimum. For instance, you could purchase a home and convert it into a bed and breakfast where you would serve meals and provide linens for visitors. Capital gains. You could make capital gains if you sell a piece of property for more than you paid. Your cost basis is the buy price you paid for the asset plus any renovations and acquisition costs, less depreciation. Your tax rate will determine whether it counts as a short-term or long-term capital gain. Selling properties owned for less than a year result in short-term capital gains subject to regular income tax rates. Depending on your total taxable income, long-term capital gains are taxed at a reduced rate than regular income, with rates between 0% to 20%, and are for assets owned for a year or more. Individual income taxes. Any gains in interest income are taxed at the same rate as your regular income if you are an investor and do not own any property. Tax benefits of investing in real estate. Numerous tax benefits might result from real estate investing. The following aspects of real estate investing can minimize your tax liability and increase your refund when you file, whether you invest in residential or commercial property. Real estate deductions. Deductions for real estate are a great way to reduce your taxable income. Typically, these deductions offset the costs of running a business and managing real estate. Particularly, the following deductions can help you in lowering your taxes: property taxes, mortgage interest, insurance, costs associated with maintaining a property, such as utilities and lawn care, repairs to buildings, deductions for home offices, advertising, travel costs, and costs associated with legal and accounting matters, as well as business supplies like laptops and printers. Because so many tax deductions are available, keeping track of your pertinent expenses is essential. Without thorough records and receipts, it is nearly hard to claim deductions. Additionally, you will need to provide documentation supporting your deductions in the event of an IRS examination. Depreciation. Investors are given a discount for how quickly structures deteriorate over time when they deduct property depreciation from their taxable income. You will specifically receive depreciation during the building per the IRS's schedule. Residential properties currently have a 27.5-year lifespan, whereas commercial properties have a 39-year duration. You are entitled to a depreciation deduction each year based on your own real estate. Say, for instance, that you possess a $50,000 business facility. Its location on the land is irrelevant. If you divide $500,000 by 39 years, your property will be eligible for a $12,820 annual depreciation deduction when you submit your taxes. Capital gains. Selling real estate for a profit triggers capital gains taxes. These taxes can be divided into two groups: short-term taxes and long-term taxes. As said earlier, long-term capital gains are profits from selling assets kept for a year or more, as opposed to short-term capital gains, which are profits from assets held for less than a year. Because the IRS views short-term capital gains as regular income, they are not eligible for tax breaks. Therefore, short-term capital gains may cause you to move up the tax scale more than once, increasing your income taxes. Thankfully, long-term capital gains result in tax benefits. They don't count as regular income and are taxed at a reduced rate than short-term gains. If you realize long-term capital gains, your profit will fall into one of three tax bands: 0%, 15%, or 20%. If you're married and filing together and have an annual income of $89,250 or less, You won't have to pay any long-term capital gains taxes. 1031 exchange. You have to pay capital gains taxes on the sale of an investment property for which you have deducted depreciation and income taxes on all earlier depreciation deductions. By employing a 1031 exchange, you can avoid this tax, referred to as depreciation recapture. If you buy another investment property with a value equal to or greater than the one you sold, you can use this benefit to postpone paying taxes on real estate sales. You can utilize the 1031 exchange rules as often as you like, but don't forget that you will face taxes if you withdraw the proceeds from a sale or use the money to purchase a less expensive property. Passive income and pass-through deductions. You may be eligible for a pass-through deduction if you operate your real estate firm as a sole proprietorship, real estate partnership, LLC, or S-Corp. Using these pass-through businesses, you can deduct 20% of your eligible company income from your taxes. Consider the scenario in which you manage rental properties via a limited real estate partnership. You make $25,000 a year from the business, so you can deduct $5,000 from your income when you file your taxes. Remember that the pass-through deduction, a Tax Cuts and Jobs Act provision, is valid through 2025. After that year, you won't be allowed to claim this deduction if the government doesn't implement any new legislation in this area. Self-employment FICA tax is included. FICA taxes for self-employed individuals typically amount to 15.3% of their income. Rental income, however, is free from this regulation. As a result, you are immune from FICA taxes if you rent out houses. Opportunity zones. Opportunity zones were also introduced under the Tax Cuts and Jobs Act for investors. By purchasing homes in areas where the economy is struggling, you can postpone paying capital gains taxes if you sell real estate. These governmental opportunity zones often require development and higher-paying jobs. The 3 tax advantages of investing in an opportunity zone are as follows. First, you won't have to worry about capital gains taxes until you sell your investment in 2026. Additionally, if you hold on to your investment for 5 or 7 years, you'll receive a 10% basis step-up on your capital gains and a 15% bonus. Finally, if you invest for at least 10 years, you can fully avoid paying capital gains taxes. Tax-deferred retirement accounts. A health savings account, HSA, or individual retirement account, IRA, that permits real estate investment is another method to get started in real estate investing. Taxes on investments can be delayed with these accounts until you take money out of them. Strategies for reducing taxes on real estate investments. Real estate investing has long been a successful strategy for accumulating wealth. What is the secret to real estate investment wealth creation? Tax reductions. Real estate investment income attracts less severe tax penalties than regular income does. Real estate investors that are savvy know what to do to reduce their tax liability and increase their profits. Discover 9 tactics to reduce taxes and help real estate investors like you run a more profitable business. 1. Maintain a property for more than a year. Holding properties for longer than a year is the first move a real estate investor may take to reduce their tax burden. The profit is taxed at your standard income tax rate if you own an investment, such as real estate property, for less than a year and sell it for a profit. If you own a security for more than a year before selling it, you can probably do so at a capital gains tax rate of 15%, which is likely to be less than half of your regular rate. Additionally, if you keep a property for longer than a year, you can profit more by leasing it and then selling it once its value has increased. 2. Have real estate in a self-directed IRA. You are probably already familiar with tax-advantaged retirement savings if you have ever held a W-2 job. Everyone has a different strategy regarding 401k plans, individual retirement accounts, IRAs, and Roth IRAs. You should be aware of the self-directed IRA if you're an investor looking for a tax break. Self-directed IRAs can be invested in various assets, such as real estate, and are held by a custodian. To purchase and own investment properties, you'll probably need to form an LLC or legal corporation, work with a custodian or trust business, and manage your self-directed IRA. This way, you can make tax-free investments in your LLC and properties. 3. Benefit from a 1031 exchange. What if you could sell a house for a profit while avoiding paying taxes on the proceeds? With a Section 1031 exchange, it is feasible. The 1031 exchange, a like-kind exchange, enables you to transfer gains from one real estate investment to another. In contrast, you'll have to pay income or capital gains taxes if you decide to count your profits as income. The best part is that 1031 exchanges allow you to reinvest every time you sell one property and buy another, helping you to accumulate wealth while lowering or avoiding taxes on your assets. 4. Increase your tax deductions. Tax reduction in real estate investing refers to increasing your deductions. Almost all real estate expenses are tax deductible. Fortunately, not just big real estate investors can take advantage of deductions. You always have the option to choose the standard deduction if your itemized deductions aren't very significant. 5. Take advantage of the 20% pass-through deduction. Real estate investors now have access to the 20% pass-through deduction, another tax minimization method that has recently become available. You might be able to deduct a whole 20% of your real estate business income from your taxable income thanks to the pass-through deductions in the Tax Cuts and Jobs Act of 2017, TCJA, which permit some small business owners to deduct an additional 20% of their net business income. The TCJA also includes opportunity zones, places identified as lacking businesses, and may allow you to invest in real estate with a lower tax burden. 6. Borrow rather than sell to realize appreciation. Let's say you purchase a property and keep it for 5 years. If you maintain and care for your asset properly, you should have equity in something worth more than it was 5 years ago. Although selling to cash in on the appreciation might be tempting, astute real estate investors borrow against appreciating assets to reduce their tax liability. You can borrow money against the asset and write off the interest payments on your taxes. Your wealth and access to money will increase as your renters can pay off your loan and your property appreciates. 7. Conduct a payment plan sale. It's unnecessary to cash out and pay taxes immediately after selling a home. Instead, think about selling in installments to lessen your tax obligation. A customer purchases your property through an installment sale and makes payments over several tax years. Doing this lets you categorize your profits as long-term capital gains instead of short-term ones. Installment sales ultimately save you money since long-term capital gains are taxed at a minimized rate. 8. Avoid paying double FICA taxes. Social Security and Medicare are funded by FICA taxes, which are employment taxes. Employers and employees each pay 7.65% in taxes, and self-employed people are responsible for paying 15.3% of their real estate investment income in taxes. This could be prevented. You don't want to be labeled by the IRS as a dealer or someone who primarily owns a property to sell it if you're a real estate investor. Instead, show investing intent to avoid dealer status and double FICA taxes. Demonstrate that you are selling properties to raise money for other types of investments, including a down payment or improvement fees. You can also think about creating a legal entity with the help of an accountant, such as a partnership, LLC, or S Corp, which has different tax expectations. 9. Depreciate properties. Real estate investors may seek appreciation, but doing so entails costs because greater property values result in higher property taxes. By depreciating your property, you can mitigate the tax implications of appreciation. A portion of the building value of your property may be written down each year. You can also depreciate capital improvements, saving you money until you sell the property and have to pay for depreciation recapture. Conclusion. Real estate can be a wise investment with the ability to generate consistent income and increase wealth. Illiquidity, or the relative difficulty in changing cash into an asset and an asset into cash, is still a disadvantage of investing in real estate. Unlike a stock or bond transaction, a real estate deal may take months to finalize, which can be finished in seconds. Finding the ideal counterparty can take weeks, even with a broker's assistance. Of course, real estate mutual funds and REITs offer higher liquidity and market pricing. But because they have a considerably stronger link to the general stock market than direct real estate investments, they come at the cost of greater volatility and fewer diversification advantages. Keep your expectations reasonable, just like with any investment, and do your study and homework before making any choices. Real estate has repeatedly been shown to be a very profitable investment instrument, but one of the biggest difficulties in entry is understanding how to invest in real estate. The good news is that everyone can learn how to invest in real estate. All it takes is time spent on self-education. This is the reason we created this special beginner's guide. Whatever your starting point, there is no justification for making real estate off limits. A successful real estate professional can be accessed through several investing strategies. Find the best strategy for yourself by taking the time to study real estate investment for beginners.
We appreciate you tuning in to one of our captivating audiobooks. For more immersive experiences, here is another audiobook we're certain you'll enjoy. Don't forget to show your support by liking this video, sharing what you loved about this audiobook in the comments section below, and subscribing for more captivating audiobooks like this. Thanks for being a part of our audiobook community.